What's up, Radar Gang? Hope you've had a great week. We are recording this on Friday, September 15th. Market just closed a few hours ago. Next week, we have a pretty big week coming up. Tuesday, we have housing starts and permits. Wednesday, we've got FOMC. Thursday, we've got jobless claims and existing home sales. And Friday, we've got PMI flash composite. So it's going to be a pretty exciting week coming up, especially with Wednesday, that FOMC. We're going to talk about that and what we expect in this podcast. In terms of equities, though, the NASDAQ did not move much this week except until Friday. So we were hovering above mid-vamp. The NASDAQ was able to hold above that up until Friday when we finally got that crack below mid-vamp. So next thing we're going to be looking for is that move towards lower vamp and possibly even Momo. But remember, that's still going to be bullish trend. If we don't break below Momo, it's going to continue to be bullish trend. We do not short bullish trends. Keep it simple. Next, let's look at bonds. Bonds, pretty much the opposite of the NASDAQ. They've been maintaining below mid-vamp, and now we are moving lower down to lower vamp. So we'll see if we can get that touch at lower vamp. But Gamma, how much lower do you think bonds can go? Wait, we're almost below the lows back in what was it, March? Oh no, we are below it already. So how much lower do you expect this to go?
Well, I do think that remember in the framework for the compound landing, the third stage, the third out of the four stages is the normalization stage. And I think that given where we are right now, bonds are bearish trend. Commodities are on the move. Obviously, they've been bullish trend now for a couple of weeks. This is all bullish for rates. Bearish bonds, bullish for rates, right? Because bonds go down, rates go up. And I think that will continue for the foreseeable future until something internally within that compound landing framework shifts. Basically, us moving from stage 3 to, in fact, stage 4. Now, in the last week, we had CPI come in at 3.7%, right? So the prior estimate, the prior figure, the estimate was for 3.6%. So we came in slightly above the estimates and above the prior figure. Obviously, inflation's been slowly ticking up. But this has been something that we've been talking about for months now, if not maybe even a year at this point, where we've said that inflation will likely come down quickly to around the 3 to 5% range, but getting it to target at 2% is going to be a lot harder than it was bringing it down from 10%. So I do think that this sticky environment that we're in right now obviously has some upside risk for rates and therefore downside for bonds. I'm always going to lean on our tools, right? So bonds are bearish trend. Now, if I were to tell you, will bonds print a new 52-week low? Given where we are right now, remember, lean on the tools. The prior 52-week low on ZB was in August, and we are bearish trend. We're under mid-vamp. So the odds are very high that we can see new 52-week lows at this point in time. Now, how does that change? Well, we'd have to first reclaim mid-vamp, right? That would add some momentum for this bid to go up. We've seen that happen a few times now in the past couple of months here. We saw it in July where there was some momentum, in August where there was some momentum, and even in June, there was some sort of momentum, but it all fizzled out after we lost mid-vamp. So mid-vamp is always a key. It's kind of like that midpoint for momentum. If you're above it, you can trend higher. If you're below it, you can trend lower. So first step is getting above mid-vamp. Next step, obviously, is flipping the trend. There's a long way to go. There's over 7% here in upward move required in bonds, an upward move required for bonds, to then flip the trend. Or at least get to Momo to where then we can flip the trend and finally flip direction in the bond space. So we're not even close to that right now. So bonds do have that downside risk. But let's also talk about retail sales. This last week, they came in at a 1.63% year over year increase. So good. Retail sales did good. Nothing really bearish there just yet. I mean, real retail sales adjusted for inflation are still negative. They're one of the few negative real indicators in terms of inflation adjusted, right, that are indicating that the consumer might not be as strong as everyone suggests. But again, still hovering around positive territory on the nominal prints, which most people is which is what most people care about, right? So the jobless claims came in under expectations. Again, not a bearish sign, and industrial production printed a 25 basis point year over year positive change. Again, nothing phenomenal and basically storytelling there, but it's all indicative of no recession at the moment, right? And that's really what we're seeing. We're not seeing this recession, and the bond trade requires that recession. So without that recession, the economy is going to try and normalize.
Yeah,
And
and let's go into the Fed funds futures because it's very interesting what we've seen over the last few days. That print there on 7/24/2024 there, that was at two rate cuts not too long ago. And
right,
so
it
now
was, yep.
now as the market is kind of starting to think, okay, we're not actually going to get a recession, it's starting to price out the probability of rate cuts because you only cut rates when there's a recession. So this is signaling that the market is starting to buy into this whole soft landing idea and that there's no recession coming. But is it possible that we can actually start to see more rate hikes be priced in, even just in the next 2-3 meetings? Not this meeting. This meeting next week coming up. There's what, a 3% chance of a rate
Right, it's
hike.
very minimal, very minimal.
It's not going to happen. But the meetings afterwards, is it possible that we can start seeing the market pricing in more hikes as it buys into this soft landing idea?
So I do think that the main driver behind stage three, right, is that normalization factor, which requires us to remove cuts from, or I don't want to say remove, but more so push them out. So basically, you're taking the cuts and you're sliding them to the right beyond a year, right? That's a real driving factor in stage three. Now, I don't think that we necessarily need to see rate hikes, right? Because if you look at the Fed's policy, and we're going to go over the ECB in a second, which is in a completely different playing field, but the Fed has real positive interest rates. They're in a position of strength. Their backs are not against the wall anymore. They have more reign on inflation, right? Or I should say they have more direct control on keeping inflation down at this point than they did even a year ago. So things are really turning around for the Fed at this point. Now, this week we're going to get the summary of economic projections, and that's the quarterly estimate where the Fed will outline what they are expecting, right? So they're going to outline what they're forecasting in the upcoming quarters in terms of economic performance. And this is something that we get quarterly, and everyone likes to look at and see where the Fed is thinking: are we going to get a recession, or are we not? And I think that you should not be too surprised if you see an improvement in their outlook. And I'm talking about to the point where we start to see this idea form where they are going to basically solidify the idea that a soft landing is becoming more attainable. And all this means is that we're going to be chugging further and further into stage three, right? So remember that idea of soft landing, that is stage three. Everyone bakes that in, and then you get stage four. So I think that this week we should see some policy or I should say some verbiage from the Fed that enforces this idea onto the public, or basically the way that they're thinking is, look, we're going to have a good shot here at a soft landing. And I'm talking about a more consensual view there, not just one speaker saying this, it really just being in the actual projections. And I think that this could remove further cuts from the curve, not necessarily adding hikes. Remember, the Fed again is in such a position where they can just hold rates now, and they can basically kill out inflation. If the Fed were to hold rates here the foreseeable future, I do think that they would be able to basically smother out inflation. Even if inflation bounces around a little bit, I think they have control on inflation at this point.
Are they
Now,
still under the risk of causing an easing effect by sounding too dovish?
I don't think so in that fact, because I think that the Federal Reserve is going, well, remember, we're talking about, we have to differentiate here. The ECB is doing something completely different here from what the Fed is doing. The Fed, you can talk about a hawkish pause, right? The Fed is, if inflation becomes an issue, the Fed will always will act from here on out. They're not scared. They're not acting out of a position of weakness, where the ECB is basically backing themselves into a corner. And we're going to go over that in a second. But the Fed, I think, if they want to talk about easing policy, I don't think that they're going to inherently add cuts to the curve. I think the curve is really starting to pick up on the idea that the Federal Reserve policy actions are on mountain peaks, right? So it's not so much like we're going to hike, and then cut. The curve has yet to really stabilize to the point where there's no action expected. And I think we're starting to get there on the back end. Like we really have shifted a lot here in the last couple of weeks. We took out almost a whole rate cut, and in the last couple of months, we've done a lot of work here on the back end, right? Of what's to be expected here in the next year. And therefore, I do think that the market is slowly going to balance out the idea, or price in the idea, I should say, that the Fed can, in fact, literally just sit there and hold interest rates. I think everyone is afraid of something breaking, and inherently so, stage 4 will likely involve the Federal Reserve cutting interest rates. So the idea that the Fed is going to have to cut rates is pretty much a massively adopted assumption, which is, I do believe as well, the Federal Reserve will cut interest rates at some point. The problem here is at what point, right? Now, if you look at the curve here, the curve is always, when you look at when you look at these policy curves, you have to understand that even if the Federal Reserve, or you call it the central bank, any of these curves or any of these banks, if the bank isn't going to move interest rates, the curve is going to still reflect some portion of move in either direction. And you can call that the market maker VIG, for example, because these are Fed funds futures in this case, right? So there's someone taking the other side of that trade that's betting, in fact, for example, 3% odds that the Fed is going to hike at this next meeting. There is someone betting that they're belonging that 3% while someone else is shorting that 3%. Now, market makers aren't going to put themselves so off sides to where they're going to bet a 50-50, because in reality, they're going to tilt the odds in one way or another if it's hawkish or dovish, because in the case, that's why when you look out on the Fed funds curve, it's always rate cuts because of where we are today. Everyone's going to price in those rate cuts because otherwise there would be no protection there for the market maker, right? The market maker is basically pricing in 1 point or one rate hike of protection at this point, or the market participants. So when you look at these curves, don't be surprised if they're plus or minus a little bit. The whole point is that we're look at it like this. In the next 12 months, the maximum we're looking at is roughly one rate cut. It's getting tight. It was 2, now it's 1. And ideally, we see this really tighten up and stabilize. And therefore, the Fed funds curve itself, the implied policy rate, flattens out, and we get this hold that we've been looking for. And eventually, will it take a year for stage 4 to hit? We don't know. That's not how this works. We don't have a stopwatch. We don't have a celestial clock, right? That's not how this game is played. The moves happen, and they basically start with indications of those moves happening, right? So the way the moves happen is they start with an indication, and those indications can come out of the blue. That's why you need to have a robust system that's monitoring all facets of the economy and market at all times, and simplifying everything and pinpointing those special or considerable moves that will in fact shift you from one cycle to the next. And I think that's what we're pretty much waiting for right now as we get into stage 3 here, and we're going to need to see that before we pivot out of stage 4. But let's go over the ECB, right? And this is a screenshot taken from the terminal about an hour ago. And let's talk about what happened this week in the ECB. So the ECB had their interest rate decision this week, and they decided to raise interest rates, as we all know they should have, right? I mean, the ECB they were behind, they were way behind the curve. They're still behind the curve, but they should have hiked interest rates. The problem was the market went into the week expecting them not to actually hike at this meeting. So that's something that, the unfortunate thing there is it happened, which is good. I should say, let me reword that. It's good that it happened. We're happy that we're seeing the ECB start, taking a fighting stance in inflation. The only problem with this whole situation is the commentary that followed that rate hike increase, right? So good, they raised rates. We're all glad. Yes, ECB is fighting. Then comes their commentary. In their commentary, they basically indicate that there is not even one. They're basically done hiking interest rates. As you can see here, the implied rate is we're right now at 3.91, right at the next meeting. Or excuse me, we're at 3.861 right now. The implied rate is we barely get to 4%. So there's not even one rate hike here left on the table. So the ECB, based on what the market.
It's interesting that the market is pricing in that they're able to hold rates at those levels for a long time.
That's interesting as well. Yes, because obviously we know the situation with the Eurozone is quite interesting compared to that of America. We got PMI. I believe both PMIs are negative, right? And there's obviously an economic slowdown there that's accelerating at a faster pace than in the United States. I mean, the euro is in a different position. Right. So I do think that, yes, in fact, that there's quite a bit of durability here in the policy perspective with them holding interest rates. But we have to also look at what's going on, right? Inflation in the Eurozone is 100 basis points higher than 4%, over 100 basis points higher than 4%. So even if we throw their terminal on the table, right, at 400 basis points, which is what they're expected to get to, one rate hike maybe, right, whatever, at this point, current inflation is still 100 plus basis points higher than here. So remember, the Fed is at 500 basis points. Inflation's came in at 3.7 this week. So Fed's in a really good spot. They can just sit back and basically hold that restrictive clamp on the market. The ECB, what they're doing is they're saying, well, the economy is slowing. If we wait here, we've let inflation come down from the 10s all the way down to the 5s now. Maybe inflation will come in and kind of meet us in the middle over here, right? Problem there is, will that happen? That's a very dangerous game to play. That's not a game the Federal Reserve wanted to play, but the ECB seems to not mind that game.
Right. So this implied rate holding on all the way through mid 2024 is kind of taking into account the slowdown, but also the excessive inflation that they have. They kind of counteract each other and leave the implied rate the same. Is that kind of what the market is telling us?
Well, no. The reason why the implied rate's the same is because if inflation doesn't slow down, no one can see the ECB cutting interest rates, right? Even if the economy starts weakening, deteriorating a bit more than it has already, it's very hard to see the ECB start cutting it. I mean, that would be extraordinary. Well, let's be honest. The ECB has all these central banks like to play these games, but the ECB has made a real mockery of itself. I do think that if they do that, I mean, it's really game on, like in terms of the next level, the next range of stupidity they're stepping into, right? I think you've reached a new level. Okay. You've gone to a new level. You've gone to new depths if you do something like that. I don't think they're going to do that, but you never know. I think that's why the market's holding steady here. The market doesn't think either that they're going to do something that irrational. But again, there's always, as they say, the ocean can always go deeper, right? You never know. So I also want to say that what this does, because obviously we want to tie this back to stage 3. What does this mean for stage 3, right? Now, all this does, them not getting inflation under control and growth kind of like in the mud where it has been right now, manufacturing, et cetera, in the mud, it increases the risk of a prolonged stagflationary period in the Eurozone, right? This never-ending stagflationary period. Obviously, it is ending, but it feels like it's never ending, right? That's what is mostly going to happen at this current rate. And what this does for stage 3 is it slows the effects on rising interest rates domestically, right? Because the United States has these real positive yields. ECB doesn't, or the Eurozone doesn't, at least not yet, right? In terms of reward. I mean, we can talk about them actually having a positive yield. I don't want to say they don't have a positive yield, but the juice is not in the Eurozone right now. It's in America. So because of that, you drive demand to U.S. bonds, right?
Right, and that's why we're seeing the move in the dollar that we've seen over the last couple of weeks.
Exactly. And that's why when this whole thing broke with the Eurozone, I don't know if some of you guys listening may have watched it. The Euro actually dove lower. Now, why would the Euro dive down on this idea that they did this was a surprise rate hike, right?
It was
The
the
rate hike was
language that they used
yeah,
afterwards.
yeah. It's the idea that the Euro. I want to rephrase it. The Euro had the idea, well, the ECB is done and inflation isn't under control. Well, shit. What now? When, again, look at the Fed. The Fed's in a much different position. Listen, the Fed can very well be creating a pretty sick recession here at some point if they hold for too long. Which again, this goes back to the compound landing. It is in our pin. It's in our highlights section on our Twitter account. You can read all about it. It's a whole thread. The high level summary of the compound landing is the Fed will go too far for too long and something will break. The degree of which things break depends on how aggressive the cycle wants to be when we get there. Long story short, that's the Fed's problem. The ECB doesn't have that problem yet because they are still talking about combating inflation. The job is done in America, or at least very close to it, and the ECB still has a lot of work to do if they really want to get inflation under control, or they really are right. And we got to read all the cards on the table, right? There's this scenario where, wait, the ECB, right? They don't need to bring rates down because inflation's on the downtrend. Look at manufacturing; it's weak in the Eurozone. So maybe they're going to go into a recession and this whole seesaw is going to magically right itself. And the ECB can sit here and basically play the trail game and let inflation come down to them, marginally move rates from here, which doesn't look like they're going to do much, right? As we said earlier. And they'll get that positive real yield and coast out into the sunset. Usually that's not how it works, right? We'll have to see. I don't think that's how it's going to work. But
If we see the inflation continue to be an issue in the Eurozone and the market starts pricing in further hikes that's needed, would that be bearish for the dollar?
Yes, that would, because remember the whole point of the euro going down, right? Remember I think we spoke about this a couple of weeks ago. I can't remember which podcast speaks so much about these things, but when a currency is basically a share in your central bank, right? If you're buying euros, you're along the ECB. If you're buying dollars, you're along the Fed. That's how this works, right? And you want to be long these banks in times of distress because the banks are the lenders of last resort, right? They're the tail risk hedges. That's why currencies do well in recessionary periods because you're betting on you're the last resort, and your last resort is being defended by the central bank. That they're line in the sand, right? So when you long these currencies, you have to assume that the central bank's going to have your back. But if the central bank disregards, or I should say disrespects, their currency holders, well, no one's going to want to own your currency. And how do you disrespect a currency owner? You inflate them out of value, right? Or I should say you deflate their value against other goods, right? Or I should say, I don't want to say that's wrong. You deflate their purchasing power, right? Against other goods, one. Or you offer them no environment to hedge out of inflationary risks. And when you have no competitive real yield landscape, what ends up happening is you have no reason to store your money there because the returns are sizable elsewhere. So in terms of the euro, why sit around in euros when you can collect a higher real yield in America, right? And this is the game that they're going to play. So if you want to get that demand into the euro, you're going to need to make the macro, or I should say the central bank landscape, more respectable for the shareholders. Someone who's going to buy the euro needs to not feel disrespected, needs to feel like they can get an actual advantage in holding euro. Until that changes, people aren't going to want to hold this. And therefore, the dollar has this bid. Now, don't get all gung-ho just yet. Dollar's still bearish trend. We have to stick to the tools. Remember this. There's no shortcuts. If it's bearish trend, this can be counter trend. This can just be one of these, okay? This can just be another one of these. be careful. I'd like to think we can get some bullish trend action here, start moving, going higher. That will be a signal that we're starting to move into stage 4.
Well,
I don't
so
know
if
yet.
if we start seeing inflation really do come under control in the eurozone, then a flip bullish trend on the dollar would be a possible long trade.
Yes,
That would
exactly.
that would
I
be a
agree.
good
Yeah.
trade opportunity right there.
Yeah. Well, no, you're saying if inflation, let's correct that. If inflation starts accelerating in the eurozone, it would be a good trade in the dollar, because if inflation comes under control, right, on the eurozone, what's going to happen is there's not going to be such a reason to flee the euro,
Right.
and they would pull some money back, therefore offsetting some of this dollar demand.
Yeah.
But what we're looking for here realistically, and we spoke about this last week, in a recession, because of the dollar's world reserve currency status and this idea that the daddy Fed will guide us to safety, everyone loves dollars in this environment, in that recessionary environment. Now, see what happens, how this plays out. Back to the tools, though. Bullish trends are the key. So let's also talk about quickly what is going on in the interest rate market, because this all ties in and finishes up this whole stage 3 issue here, right? Stage 3 is all about normalization. Now I have on my chart here the 5-year yield and the 5-year break evens. Okay. And the way we get a real yield, for those that are new or don't know how that's calculated, is we take the 5-year yield minus the 5-year expected inflation rate, the break even rate, and we get the real yield. But real yields are irrelevant right now. All you need to know is that nominal rates are going up, but break even inflation rates are not. What this is telling you is that inflation is not the primary driver at the current point in stage 3, right? If you look at this, what you can see is real yields are expanding, and the market is continuing to play the game that where it's trying to normalize an economy at a new higher level of interest rates. Now, you might say, well, that should be inflationary at some point. Yes and no, because you have to look at where break evens haven't gone, right? And where they are today. So the break evens are at roughly 2.25. Now, rates are much higher, commodities are much higher, but break evens haven't moved. The key here is they also haven't gone down either, right? This is measuring the average rate of inflation over the next 5 years, and they're putting it at about 2.25. Well, if you're going to want to see this economy slow and inflation really slow down to the point where the Fed needs to cut interest rates, the break evens have to go into the Fed target. I don't want to use the word have to, but think about it, right? If the Fed is telling you that they need inflation back to target, break evens are well anchored. And you'll hear Powell most likely talk about this week, because commodity prices are up, oil's up. Everyone's going to probably ask him questions. Oh, with this move in, you're probably going to hear a bunch of questions like, with the move in commodities, with the move in oil, how does that change the Fed stance? And Powell will probably just tell you that he's data dependent and they're ready to move if they need to. And break evens remain well anchored, right? So what he's basically saying is the break-even interest rates are implying that there isn't really an inflationary push the market is seeing just yet. And I think that we'll see further guidance from the Fed on this inflationary move, and specifically where they expect this soft landing narrative or this soft landing direction to go. And that will in turn fuel further real yield restrictiveness in the market, because if the economy isn't going to slow down, and all that really means, I want to say that real yield restrictiveness means nominal rates go up, but these break evens stay glued. And what that's implying is the Fed has this. Remember, nominals are not the same as break evens. The Fed has more control over the orange than they do with the black line. So everyone know the Fed literally at every FOMC meeting, they reiterate that they are not changing the inflation target. The inflation target is 2%, 2%, 2%, 2%. It's always 2%. Why it's 2%? They don't even know, but it's 2%. That's all you need to know. Okay. So 2% means that until break evens are under 2%, the market's pricing in above expected or target inflation. Therefore, the Fed's going to have to remain restrictive. Okay. It doesn't mean that inflation is going to break out because the Fed is already in this restrictive state, meaning they have this control over inflation. It's now not a game of pushing rates higher and higher. It's about holding. So as these rates go up and break even stay sideways, it's signaling that, remember, the 5-year interest rate right now is only 4.467. The Fed funds rate right now is 5.25.
Well,
So what this is saying is,
isn't this kind of signaling that the move in commodities and crude oil that we're seeing right now is an overextension, and that there's downward pressure pushing that lower?
pushing what lower? The break evens or commodities?
Commodities. Like, isn't
Right.
there a downward force acting on these? And so the move that we've seen over the last few weeks in crude oil and other commodities, it's more of an overextension.
No, not necessarily, because remember this idea that inflation expectations remain anchored. We know that, right? So it's not driven by inflation, but nominals keep edging higher. And the reason why they're edging higher is the idea that in the next 5 years, right, more time is going to be required at these higher levels of interest. Therefore, look, we're going out 5 years and we're at 4.46. The Fed's at 5.25. Why is this not at 5.25? Well, obviously, the Fed's not expected to hold interest rates at 5.25 for the next 5 years. But the higher for longer soft landing narrative, whatever you want to call it, implies the Federal Reserve has to hold interest rates, or basically normalize interest rates at these levels to basically stabilize the economy. Meaning, if inflation's not breaking out and rates are going up, what this is showing you is there's this demand push. I wouldn't say pull. I wouldn't say pull or downward pressure. I would phrase it with upwards pressure. Right? There's this upward pressure of demand push where the economy is looking at the situation, or the market's looking at the situation and saying, "Well, we got to bid up nominals because the Fed's not going to reduce rates to the dramatic effect everyone thought they would because there's no recession, right? And they're going to keep pushing rates up until basically break evens crack, or at least hold them higher until break evens crack. The Fed has these, these break evens, the Fed has them, everyone has them. Everyone knows what they are, right? So the Fed knows that break evens are about 2.25 for 5 years. They're going to make sure they get that down to target. Now, they don't need to hike to bring this 5-year rate up because it's already discounted to the current federal funds rate. All they need to do is hold rates for, the market needs to just start thinking they're going to hold rates for longer than expected. And you start taking up a larger window of the next 5 years, right? And therefore, the average rate needs to go up. The 5-year rate needs to go up. And what ends up happening, why that's happening, is because there's this idea of economic stabilization, normalization. And therefore, when you get this normalization effect, there's no reason that people shouldn't be buying commodities, right? Because if the economy isn't slowing and it's almost accelerating, right? It's not slowing. I don't want to say it's accelerating. I want to say it's resilient, right? The economy is resilient, right? Therefore, we had an earnings recession in equities the last 18 months, right? And we're coming out of it. That earnings recession in equities flowed across the whole market. The market that we all thought, the market itself thought we were going to go into an actual recession, right? And commodity prices acted accordingly. And the recession was almost always 1 month away, but never came. So commodities never really unloaded. Like crude oil, we got down to the $65, bounced around there a couple of times, but we never really unloaded. There wasn't really like it was just this slow grind lower. And once you hit the curb of, or the pivot point where there's no recession, or there's not this idea of a recession emerging, well, what happens then? Everyone that sold short, dumped commodities in the idea that there's going to be no demand for oil. Well, if the economy, remember, their thoughts for there's no demand for oil, there's no reasons because the economy is going to slow drastically because of interest rates. And that didn't happen. So what's going to happen now is everyone's going to start to reevaluate their positions and say, maybe the economy is more resilient. Well, if the economy is more resilient, then businesses are more resilient, then oil consumption is more resilient, right? So on and so forth. And that means oil prices need to go up. And that's what we've been seeing. And that's stage 3. But eventually what happens is the cycle filters through and we get the actual stage 4. And that's when you've exhausted this normalization process. You realize that you can't normalize an economy. Remember, if you really want to normalize this economy, you need the long end over the front end. You need to revert that yield curve, meaning 30-year treasuries need to be yielding over 5.25% or 5% at these rates if you want to normalize at this level, which I don't think we're going to get that. That's extreme. Something breaks before you get there. You're talking about mortgage rates over in the 12% range. Something will crack along the way.
Yeah. And so that's, right? We're seeing the bear.
That's stage 4.
We're seeing the bear steepener in stage 3, where it's the market's trying to do that, but then something will break and we'll get the bull steepener, and that's going to be stage 4.
Exactly. And I think the bear steepener, it's been trying, right? Like in terms of the yield, we haven't seen this. We saw this nice acceleration off of July, but we haven't really seen an acceleration from there over the last even 2 months, month and a half. And that's primarily driven from the fact that it's very hard to normalize the curve, the entire curve. You're talking about 2s and 10s, right? The difference between the front end and 10-year at the current rate level. You're talking about a drastic, the 70 basis points. That's a journey. Now, I do think that the bear steepener is a driving factor in stage 3, meaning the bear steepener is the push up. Everyone's like, oh, this is the time the yield curve reverts without the recession. We may very well see that. But we have to look at both sides of the coin, right? Always simple, level-headed from the top down. If the rest of the world is driving demand here for our bonds, Japan rates are too low, right? Euro, they're dropping the ball, it seems like, again. It's going to be hard to get that bear steepener because there's going to be demand there globally. What accelerates the bear steepener is the complete opposite, right? It basically accelerates the stage 3 effects, is where Japan starts raising interest rates aggressively, therefore reshoring demand. Same thing with the euro. And to reshore their currencies, they have to basically let bonds mature or sell off treasuries and not hold as much treasuries, and therefore pushing up longer term yields. Any duration assets they hold would be very influential on longer term interest rates. I don't think we're going to see that, at least not yet, but I do think we can get that bear steepener. I just don't think, what I should say is I do think that if those things were to happen outside the US, the bear steepener would be much more aggressive. We're talking about a bear steepener in terms of basically this in reverse, right? Just straight up. And if we had to just draw some line here for those to understand, like if something like that were to happen, it would kind of look like this.
Right. And the volatility of that kind of move
would be ridiculous.
Yeah, that would also cause a lot of things to break.
That would basically, remember. So think of it like this. The rest of the world gets their shit in check, they accelerate stage 3. The rest of the world wants to play games and wants to basically lollygag around with their interest rate policy, it slows stage 3 down. That's how you should think about it. But long story short, I do think we get stage 4. Could we get a soft landing? I'm not naive. I'm not here to tell you guys, oh, it's recession, doom and gloom, buy gold, Peter Schiff. No, I'm not going to tell you guys to do any of that shit, okay? Because at the end of the day, I do think stage 4 will happen, but there is always a possibility. There is always a possibility that things get strung out and the regime can cycle through and we can get a risk-on regime. Will it be the real risk-on regime, or will it only last a few months? I don't know. But it's not very possible. It's possible. I think the stage 4 scenario is still very possible. It's the most possible in terms of cycling through stage 3 and getting stage 4. But I want you guys to always put the narratives in the passenger seat, right? The narratives do not drive your car. You are not an idiot. You can control how you act. Your narrative doesn't control you. Your narrative is there, or the narrative that you're looking at is there to guide you. You look at the narrative and you say, okay, this is what should happen, A, B, and C, because of boop, 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 boop. That's why these things should happen. And if one of them doesn't happen, it's okay. Why didn't it happen? Okay, maybe the next thing will happen. If not, okay, maybe we need to flip the narrative here and we need to position accordingly. Not, oh, this is going to happen. It's not happening. That means it just hasn't happened yet. I'm going to sit here and wait. That's not how this works, because you end up a perma. And you do not want to be a perma bull or a perma bear. You want to be dynamic, fluid, and you want to take the shots as they come and roll with the tides and in and out and up and down. And in the end, you want to be on top. And I don't think you will be able to do that by blindly following narratives. Always keep a multi-factor or some type of double checking. That's why our system is multi-factor, or our tools. Everything is built around this idea that the narratives aren't right. They're built usually around opinion. If we build our narratives around our models, if our models change, our narratives change, and the show goes on. Thank you guys so much for listening. If you have any questions, feel free to reach out to us on Twitter at The Market Radar. If you want to check our website out, we offer daily weather reports, which include all our macro models, at market-radar.com.